All right, let's dive in. We're taking a deep dive today into Secrets of Sand Hill Road.
Oh,
It's by Scott Kupor. He's a managing partner at, the legendary Andreessen Horowitz, the venture capital firm.
yeah.
Now, this deep dive, it's not just for aspiring entrepreneurs or anything.
Right.
We're going way beyond just the startups themselves
Okay.
to uncover how VC shapes kind of the whole tech world, right? And
Wow.
maybe even pick up a few investment insights for ourselves along the way.
Oh, absolutely. I think what's so interesting about this book is that Kupor, he really doesn't shy away from that
Yeah.
roller coaster ride that is
Yeah.
venture capital. He takes us all the way back
Yeah.
to the late 90s,
Oh, wow.
the peak of the dot-com bubble,
Right.
where, exuberance sometimes really overshadowed logic.
Oh, for sure. And I think most people, they remember that time for the big names that survived. But
Right.
Kupor paints this really, really vivid picture of this almost forgotten landscape. Like companies like Epiphany, NetIQ, VA Linux.
Right.
These were the companies, back then everyone was scrambling to invest in.
Yeah.
And Kupor, he landed right in the middle of it all,
Wow.
working on IPOs at Credit Suisse first, Boston.
Okay. Yeah.
Yes.
And here's where it gets really mind-blowing. I mean, in 2000, VC funding was
Yeah.
more than 3 times higher than it was in 2017. Can you imagine?
It's hard to even fathom, right?
Yeah.
Just how much the market was just...
The market was just on fire.
Yeah.
Driven by this almost irrational belief that the
Yeah.
growth would just continue forever.
Yeah. It was like the whole tech world was playing this high stakes game of musical chairs,
Yeah.
except no one believed the music would ever actually stop. Right.
And of course it did.
Oh, it did. And Kupor's, own journey, I think, really reflects that shift.
Yeah.
His company, LoudCloud, they went public right when the bubble burst. Oh, wow.
And eventually, that led him to Andreessen Horowitz.
Right.
So talk about being in the right place at the right time.
Or the wrong time, depending on how you look at it.
Yeah. Yeah, exactly.
Mm.
Kupor's experience, it kind of offers this amazing microcosm of,
Yeah.
venture capital's just volatility,
Yeah.
which I think, really underlines a crucial lesson for all of us.
Yeah.
Whether, you're a seasoned investor or just trying to kind of wrap your head around the tech world,
Right.
risk is just inherent to this industry. It's
Yeah, it's baked in.
it's just part of the game.
Yeah. So let's unpack some of those myths, some of those misconceptions around venture capital.
Yeah.
I think one really common one is that it's just as simple as writing a check and then waiting for the cash to roll in. You know what I mean?
You would think, right.
Right. But
But as Kupor explains, the reality is far more
yeah.
involved.
Oh.
It's dynamic. It's
Yeah.
venture capitalists are really deeply embedded in the companies that they back.
Right.
They're actively involved in recruiting, in forging strategic partnerships,
Yeah.
and in guiding the company, over multiple rounds of funding.
Yeah.
It's a long game,
It is. It is.
often spanning 5 to 10 years,
More than that sometimes.
even longer.
Yeah. It's really more like a close partnership, wouldn't you say?
Absolutely. I mean, the goal is to
Yeah.
to really cultivate growth,
Right.
not just chase these quick returns.
Right. Right. Now, to really kind of get a grasp of the VC world, I think we need to understand the role of limited partners,
Right.
or LPs. Who are these mysterious figures?
Yeah. So think of LPs as the fuel behind the VC engine.
Okay.
They're the institutions and the high net worth individuals who
Okay.
invest in venture capital funds.
Right.
Their motive,
Yeah.
they're looking for what's called alpha, returns that outpace traditional benchmarks,
Oh, okay.
like the S&P 500.
I see.
Um,
Kupor uses Yale's endowment as a prime example.
yes.
They allocate a significant portion of their portfolio to VC
Yeah.
with the goal of achieving returns exceeding 18%.
And it's not just university endowment.
Right.
You have foundations, pension funds,
That's a whole world.
a whole ecosystem of players, right?
Yeah.
Each with their own unique investment objectives.
Right. But the common thread is they're all looking to outperform the market.
Yeah, they're all trying to kind of to beat the market, right?
Right. Right. Which brings us to kind of a reality check. I mean, I think Kupor is is refreshingly candid
Yeah.
about the risks associated with venture capital. He doesn't
He
he doesn't
does.
sugarcoat it.
No, he doesn't.
Yeah.
He debunks the myth of guarantee high returns.
Yeah.
Right. Highlighting that only a small fraction of
Right.
VC investments generate, those massive headline grabbing figures.
Right.
The reality is that median returns, often lag
It's
behind.
all market.
Yeah, behind the overall market.
Right. He uses this, I love this. He uses this baseball analogy
Oh, it's a great one.
to illustrate the point. VCs, they're like batters.
Yeah.
They're wrong about half the time. 50% of their investments, they strike out,
They strike out.
so to speak.
Right.
Yeah.
But here's the catch. Those few investments that really hit it out of the park,
Yeah.
the home runs,
The home runs.
those are what make up for
Right.
all the
Good.
strikeouts.
Those strikeouts. Yeah.
So it's all about understanding, I think.
Yeah.
Understanding the nature of the game.
Yeah.
You're swinging for the fences,
Yeah.
knowing you might miss a lot.
Right.
But that one home run
That one can change everything.
to change everything.
And that ties into another really critical factor.
Yeah.
Market size.
Yeah, market size, it's critical.
Right.
Investing in a stellar company
Right.
within a limited market
Right.
ultimately caps your potential return.
Right.
You need both a great company
Right.
and a vast, addressable market for those home runs
Yeah.
to truly pay off.
Right. Exactly. One concept that I thought was really interesting was this founder market fit.
Founder market fit. It's a good one.
Yeah.
I don't hear that discussed a lot.
No, not a lot.
Outside
Outside of the VC world.
of VC circles.
Right.
Yeah.
But it's about so much more than just, having a good idea.
A good idea, right?
Yeah.
Founder market fit is about aligning the founder's
Right.
unique skills, experiences, even personality
Yeah.
with the specific market they're targeting.
Right. Like almost like matching a key to a lock.
Yes.
You
You need that precise fit.
need that precise fit, for
Yeah.
it to work. And Kupor uses this example of Martin Casado,
Yeah.
the founder of Nicira,
Yep.
which was later acquired by VMware
Okay.
for a cool $1.25 billion.
Wow.
But Casado's background,
Yeah.
from his time in the intelligence community to his Stanford PhD.
Wow.
It was tailor-made for tackling this idea of software-defined networking.
Yeah. This raises a fascinating question. I think
Yeah.
what unique experiences or skills would make you
Right.
the ideal founder for a particular type of company?
Right.
What's your unfair advantage?
Yeah. What's that unique?
What's that unique perspective you bring to the table?
Yeah. Yeah. It's a powerful question to consider, and it leads perfectly into kind of that next stage of the VC journey.
Okay.
Pitching your idea to investors.
Yeah.
Right. We've all seen those TV shows with
We've all seen it. Yeah.
entrepreneurs
Yeah.
passionately presenting their financials and projections.
Right. Right.
But,
But Kupor really emphasizes that it's not just about the numbers.
right.
It's venture capitalists are seeking a compelling story.
Right.
They want to grasp the founder's vision,
Yeah.
be captivated by their passion,
Right.
and see how that passion, translates into a viable business.
Right. Because ultimately they're investing in people as much as they're investing in the ideas.
Absolutely.
Yeah. And a crucial part of that pitch is articulating the market opportunity
Yeah.
and your go-to-market strategy.
Right. Right.
How big is the market realistically,
Yeah.
and how will you reach those customers?
Yeah. Those customers.
Kupor uses the example of Okta,
Okta.
a company that initially targeted small businesses,
Okay.
but later found more success with large enterprises. Oh, okay. Due to kind of the rise of SaaS applications,
Yes.
But their ability to adapt and pinpoint that ideal market,
Right.
it was key to their growth.
So it's not just about understanding your product,
Right.
but the entire ecosystem it exists in, and
Right.
how you'll navigate
Yeah.
that ecosystem to achieve sustainable growth.
Right. Because ultimately VCs are looking for businesses
Yeah.
that can scale.
Scale.
Not just a good idea that
Good idea that
might fizzle out.
yeah, that might just fizzle out.
Right. Okay. So let's say your pitch, it blows them away,
Yeah.
right? They're practically throwing money at you.
Right.
But then comes that moment every entrepreneur dreads,
Right. Yeah.
the term sheet.
The term sheet.
Right. And this is where the information asymmetry, I think, that we touched upon earlier really kicks in.
Oh, yeah. VCs, they live and breathe term sheets.
They do.
Right. While for most founders, it's a whole...
It's a foreign language.
New language.
Yeah.
Right? Yeah, and Kupor doesn't... He doesn't shy away from the complexity of it.
No, he breaks down these concepts in plain English.
Right.
Pre-money versus post-money valuation.
Yeah.
Liquidation preference.
Right.
Anti-dilution provisions.
Yeah.
Pro rata rights. All the things that can
make your head spin.
Really make your head spin.
Yeah.
But he really emphasizes that it's crucial to really understand these terms.
Absolutely.
Not just, blindly accept them. It's your company.
It's your company.
Your future on the line.
Yeah, your future's on the line.
Right.
Yeah.
And his most valuable advice, I think, is to focus on maximizing your chances of success in the next round of funding.
Right.
Not just getting the highest valuation.
The highest valuation
today.
Right. Right, because it's a long game.
It is a long game. Yeah.
And a short-term win might, set you up for failure down the road.
Right.
If you're not careful.
Yeah. So once the deal is done, the funding's secured, another key player enters the scene.
Okay.
Right? The board of directors.
The board of directors.
Right. And the board, it has this dual role.
Okay.
Representing both common shareholders.
Okay.
Which includes the founders.
Right.
And preferred shareholders, which are the
VCs.
The VCs.
Yeah. And this can lead to conflicts, especially during acquisitions or when a company needs a kind of a rescue. Via a down round or
a
recapitalization. Kupor uses the Trados case to illustrate how things can go wrong when the board prioritizes preferred shareholders over
common shareholders.
Yeah, it's a cautionary tale, I think.
It is
about the power dynamics that can really
come into play. Yeah, I think the key takeaway there is that while the board is, legally obligated to act in the best interests of the company.
This company as a whole. Yeah.
Right.
The interests of different shareholder groups aren't
always aligned.
Right. Yeah. So it's a tricky, speaking of potentially challenging situations, let's talk about down rounds.
Oh, down rounds.
No
founder wants to
face.
Right. But which is, a reality. In the startup world.
Yeah.
Right.
Yeah. A down round is essentially raising capital at lower valuation than your previous round.
Right.
Often due to, challenges or shifting market conditions.
Right.
But rather than viewing it as a death knell coup, he reframes it as a potential opportunity.
Oh, interesting.
Right. It's like hitting the reset button.
Right. Yeah. Okay.
You get to kind of,
It's not always a disaster.
No.
It's about navigating those choppy waters.
Yeah, navigating those choppy waters.
Wisely. And as always, being mindful of the long-term implications of your
choices.
Of your choices, yeah. Now let's shift our focus to the end game.
Okay, the end game.
Yeah.
Exits. Right. There are two primary paths.
Yeah.
Acquisition.
Okay.
By another company or a public offering, an IPO.
An IPO, and as you might have guessed, IPOs are
less common these days.
Far less common than they used to be.
Why is that? Companies are now able to remain private.
Right.
For longer periods.
Yeah.
Right? Access ample private capital.
Right.
And even achieve, significant brand recognition.
Yeah.
Before going public.
So the IPO isn't the only measure of success anymore?
Exactly.
Right.
And with this shift, we see venture capitalists taking on a more expansive role.
Right.
Offering support that extends beyond capital. They're becoming involved in recruiting, marketing.
Yeah.
Essentially acting as comprehensive business partners.
Right. So it's a more holistic approach to fostering a company's growth.
Precisely. Yeah. Venture capitalists are becoming more, deeply integrated into their portfolio companies.
Right.
Helping shape their trajectory, from early stages to eventual exit.
Right. So we've covered a lot of ground already. From the Wild West of the .com boom to the intricacies of term sheets and boardroom dynamics.
Yeah. But we've only scratched the surface, I think.
Oh, I'm sure. I'm curious. What other insights does Kupor offer? I'm eager to dive.
Let's dive in
deeper.
One of the I think less discussed but equally fascinating aspects of VC is this concept of signaling.
Signaling.
Yeah.
Okay, tell me more. I'm intrigued.
Yeah, so essentially signaling is the idea that certain actions taken by VCs send a message to other investors, potential acquirers.
Right.
Even the market at large.
Yeah.
It's about reputation, credibility.
Yeah.
Building a track record of success.
Well, for example, if a prominent firm like Andreessen Horowitz invests in a company.
Yeah. That investment becomes a powerful signal to others that this company's, worth a closer look.
It's almost like a stamp of approval.
A stamp of approval.
Yeah.
Validating the team, the idea.
Validating the team, the idea.
Kind of like when a friend whose taste you trust recommends a new band.
Exactly.
You're instantly
more likely to check them out.
Yeah.
Right.
Yeah, and this signaling it plays a role throughout the entire life cycle of a venture-backed company.
Right.
From those initial seed rounds all the way to a potential exit.
You mentioned rounds. Kupor also delves into those different stages of funding, Series A, Series B, and so on. What's the significance of those labels?
Yeah. So each round marks a milestone.
Okay.
In a company's kind of growth trajectory.
Okay.
And the valuation assigned at each round.
Yeah.
Signals to the market.
Okay.
How the company is progressing and its potential for future success.
It's almost like leveling up.
Yeah.
In a video game.
I like that.
Right.
Yeah.
Each round represents a new achievement.
That unlocks further,
further opportunities.
Challenges.
And these rounds, they're not just arbitrary.
No, they're not.
Designation.
They're typically tied to specific milestones.
Okay.
Whether it's, hitting revenue targets, launching a new product, expanding into new markets.
Right. So it's not just about accumulating.
No, it's about demonstrating
right.
Strategic growth
right.
and progress towards a larger goal.
Each round tells a story.
It does. It provides a framework for understanding how a company is evolving and creating value over time.
Let's shift gears for a moment and talk about kind of the less glamorous but equally important aspects of venture capital. You know, the legal and financial mechanics.
Yes.
Right.
Yeah.
Kupor, he gets into the nitty-gritty of things.
He does.
Like valuation marks, carried interest, and clawbacks.
Right. These are the nuts and bolts.
Yeah.
That hold the entire VC system together.
Right.
And while they might seem a bit dry at first.
A little dry.
Understanding these mechanics is crucial, I think, for both entrepreneurs and investors.
For instance, Kupor explains how venture firms determine the value of their portfolio companies. A process that's not as straightforward.
Not as straightforward as you might think.
Right. Remember, these companies aren't publicly traded.
Right.
So there's no stock ticker.
Right. To instantly tell you their worth. Venture firms use various methods to estimate these valuations.
Yeah.
Often relying on comparable company analysis.
Okay.
Or the most recent round of funding.
It's almost like trying to appraise a house in a neighborhood with no other houses.
Right.
Quite like it.
Yeah.
You have to look for similar properties.
Similar properties.
Who make educated guesses.
Educated guesses.
Based on market trends.
Based on market trends, other factors.
With other factors.
Exactly.
Right.
And these valuation marks, they play a key role in determining the carried interest.
Okay.
That the general partners of a venture firm receive.
Carried interest being that percentage of profits.
Yes.
That the GPs get to
keep.
Right.
Yeah, it's their reward
Yeah.
for successfully investing in companies that generate significant returns.
But and this is where it gets interesting. I think Kupor also talks about these things called clawbacks.
Clawbacks.
Yeah.
What are
So clawbacks are mechanisms designed to ensure that the GPs don't walk away with all the profits if their investments sour down the road.
Okay.
It's a way to protect the limited partners.
Yeah.
The ones who initially provided the capital.
So it's almost like an insurance policy?
It is. It's like an insurance policy.
For the LPs.
For the LPs.
Making sure they're not left holding the bag.
Holding the bag.
If things go south.
If things go south.
Right.
Yeah. Clawbacks help align incentives between the GPs and the LPs.
Yeah.
Ensuring, everyone has skin in the game.
Right.
And is motivated to achieve long-term success.
Mm-hmm.
Now, one of the most I think compelling aspects of the book is how it highlights this this evolving relationship between venture capitalists and the companies they invest in.
Yeah.
Kupor argues that VCs are becoming more than just money men.
Money men.
Right.
Yeah, they're taking on a more active role.
Right.
Offering support that goes beyond capital.
Right.
They're assisting with recruiting, marketing, essentially serving as strategic advisors throughout the company's journey.
It's almost as if they're becoming true partners.
True partners.
Right. Invested in the holistic success of the company, not just fixated on financial returns.
Precisely. And this evolution is driven by several factors, I think, including the increasing complexity of the tech landscape.
Yeah.
The longer time horizons before companies go public and the heightened competition within the venture capital industry itself.
It's like VCs are realizing that to truly excel in this game, they need to
more to the table
than just
money.
Yeah, and money.
They need to offer expertise, connections, that intangible value add that can truly make a difference for a startup.
And this shift has implications for entrepreneurs as well.
It does.
Right? I mean, when choosing a VC partner, you're not just looking to write a check.
To write a check.
Right.
You're looking for a team that can
support you.
Guide you.
I do, yeah.
And help you navigate the inevitable
ups and downs
of building a successful company. So it's becoming more about finding the right fit, a true partnership that transcends the purely financial aspect.
Right. Kupor's insights into this changing dynamic, I think, are invaluable.
Yeah, they're invaluable
for both entrepreneurs and those looking to understand the broader VC landscape.
The broader VC landscape.
Yeah. Now, speaking of partnerships, Kupor also delves into the unique dynamics between general partners, GPs, and limited partner LPs within a venture fund.
Yeah. It's a relationship built on trust, transparency, and of course the shared pursuit of
those outsized returns.
Yeah, those outsized returns.
Yeah.
But it can also be a relationship, fraught with tension.
Yeah.
Especially when those returns don't materialize as quickly or consistently as everyone hoped.
It's like any relationship.
Right, like any relationship.
Yeah, you have shared goals. Aspirations.
Right.
But there are also, inherent power dynamics. And potential for conflict that need to be
carefully managed. Exactly.
Right.
And Kupor offers, valuable insights into how successful venture funds navigate these these complexities from structuring agreements to communicating openly with LPs to making tough decisions when things don't go according to plan. It's a masterclass, I think.
Yeah.
In relationship management, Silicon Valley style.
It makes you realize that, you know, behind all the numbers and the financial jargon,
venture capital it's
a human endeavor.
Ultimately a human endeavor.
Yeah.
Yeah.
It's about
people.
People working together.
People working together.
It's taking risks.
And striving to build something.
Build something extraordinary.
Extraordinary, yeah. And that's a great point. And Kupor's emphasis on best ideas.
Best ideas.
I think underscores this human element.
It does. He argues that the best investment opportunities you know, should be directed into the fund itself.
Right.
Not siphoned off for the personal gain of the GPs. This speaks volumes, I think.
It does.
About ethics and aligning incentives.
Right. It's about ensuring that everyone involved is working towards the same goal.
The same goal.
Generating those outsized returns.
Yeah.
But while maintaining ethical practices and transparency.
Yeah. And this principle, you know, extends to the relationship between the venture firm and the portfolio companies. It's about, you know,
making decisions that benefit the company as a whole.
Right.
Not just prioritizing, you know, the investors or the founders.
Right. So it's about fostering sustainable growth.
Right.
Creating value.
Creating value.
For all stakeholders.
All stakeholders.
Not just chasing quick profits.
Quick profits
at the expense of long-term vision.
Long-term vision.
It's refreshing to see that you know, ethical considerations are becoming more prominent. In the VC world.
Absolutely. And Kupor's, you know, insights into these ethical dimensions, I think, provide valuable guidance.
Yeah.
For anyone involved in venture capital.
Right.
Whether, you know, you're an entrepreneur seeking funding,
right?
An investor looking for opportunities, or simply someone who wants to understand how this industry operates.
I'm curious to hear more about the practical aspects of building a company from the ground up.
Yeah.
Does Kupor offer guidance on those early stages?
He does. He dedicates a pretty significant portion of the book to walking through those initial stages of company formation. It's like a practical guide.
Okay.
Covering everything from, you know, choosing the right legal structure.
Okay.
To safeguarding intellectual property.
Right.
To structuring equity agreements for founders and employees.
It sounds incredibly valuable for anyone, you know, contemplating the startup journey.
Yeah, especially those crucial details.
Yeah.
You know, you might not even realize you need to consider until it's too late.
Exactly. What kind of what kind of specific advice does he offer?
So, for instance, he explains why, you know, most startups opt for that traditional C corporation structure, outlining its benefits and drawbacks.
Right.
Particularly when it comes to attracting venture capital. He also digs into, you know, the complexities of stock vesting.
Okay.
For both founders and employees.
Right.
Highlighting how these agreements can, you know, create long-term incentives.
Okay.
And safeguard the company, you know, in case of a founder breakup or employee departure.
It's about finding that balance between, you know, rewarding those who contribute to a company's success.
Yeah.
But also, you know, simultaneously protecting its future.
Protecting its future, yeah. Understanding these legal and financial nuances early on is critical.
It is.
You know, as they can significantly impact the company's, you know, growth trajectory and its ability to attract future investment.
Which brings us to a pivotal, often nerve-wracking milestone in a startup's journey.
Yes.
Raising capital.
From VCs. It's a process that can be, you know, both exhilarating and terrifying. It's a high-stakes game with the potential for, you know, life-changing outcomes.
And Kupor, he doesn't sugarcoat the challengers.
No, he doesn't. He provides a really, I think, realistic and insightful glimpse into what it takes to secure funding, from crafting a compelling pitch to navigating those,
those
often daunting term sheets.
And he stresses that
it's not just about presenting impressive numbers.
Right. VCs they're looking for that spark, that compelling narrative.
Right. They want to grasp the founder's vision, feel their passion, and believe in their ability to execute.
It sounds almost as intense as a job interview.
As a job interview, but
with the stakes
amplified tenfold.
In a way it is, but it's also a two-way street. Entrepreneurs need to be just as discerning when evaluating potential VC partners. It's about finding those who align with your vision, bring valuable expertise to the table. And can be trusted to support you through the inevitable challenge.
So once again, it comes back to
finding
the right fit.
That genuine partnership that goes beyond, a mere transaction.
And this is where
Kupor's advice is invaluable, I think.
It's invaluable.
He provides these practical tips on navigating the fundraising process. From identifying the right investors to crafting a pitch that resonates. To negotiating
favorable terms.
So he highlights the importance of clearly articulating the market opportunity and your go-to-market strategy. How big is the market? Realistically. And how will you reach your target customers? He also emphasizes, the need to outline the milestones you plan to achieve with the funding, demonstrating to potential investors that you have, a clear roadmap for growth,
and a path to achieving those coveted, home run returns.
It's about painting that vivid picture.
It is
of the future, showcasing not just what your company is today, but what it has
the potential to become.
It's about inspiring belief. In your vision.
Exactly. Now let's dive into the heart of any venture capital deal. The term sheet.
The term sheet.
This is where the
rubber meets the road.
Right. The document that outlines the terms of the investment and sets the stage for the relationship between the company and its investors.
As we discussed, this is where that information asymmetry can really put entrepreneurs at a disadvantage.
VCs are
fluent
in term sheet
language,
while many founders are encountering it for the first time. Right.
But Kupor
comes to the rescue.
Right.
He
breaks it down.
Breaks down those complex concepts into plain English. From pre-money versus post-money valuation to liquidation preference to anti-dilution provisions to pro rata rights. He provides a really, I think, clear and concise guide to understanding what each term means and how it impacts the company, the founders, the investors.
It's like having a decoder ring.
A decoder ring.
For the often confusing language of venture capital.
His aim, I think, is to really empower entrepreneurs to negotiate effectively, ensuring they comprehend the implications of each term and secure a deal that benefits all parties involved.
Can we break down some of those key terms?
Let's do it.
I think a refresher would be helpful. Let's start with pre-money valuation and post-money valuation. What's the distinction?
So pre-money valuation is the value assigned to a company before any any new investment is made.
Okay.
Post-money valuation is the value
Yeah.
after the investment.
Right.
It seems simple.
Right.
But this distinction is crucial for determining, how much ownership the investors will receive in exchange for their
capital. So for example, if a company has a pre-money valuation of say
$10 million and raises $5 million in funding.
Right.
Its post-money valuation would be
$15 million.
$15 million.
Right.
And that means
this means
the investor, provided the $5 million, would own 1/3 of the company. Another crucial term is liquidation preference.
Liquidation preference.
And this outlines how the proceeds from a sale or liquidation event are distributed
on the shareholders.
The shareholders.
And this is where
it gets tricky.
Things can get a bit tricky.
Right. Preferred shareholders, like the VCs, often have a preference over common shareholders,
like the founders and employees.
Yeah. Liquidation preference can take many forms.
Right.
A common one is a 1x preference, meaning preferred shareholders. They recoup their initial investment before any proceeds are distributed
to the common shareholder. So if a company sells for say $20 million. And the preferred shareholders invested $10 million.
Right.
They'd get their
$10 million back first.
$10 million back first.
Leaving the remaining $10 million to be divided among the common shareholders.
Yeah.
And this can significantly impact the outcome for founders and employees. Especially if the sale price isn't substantially higher than the total.
It underscores the importance of understanding that.
Right.
Even in a successful exit. The spoils aren't always shared. Equally.
Yeah. The deal structure.
Right.
Those terms laid out
in the term sheet.
Can have a major impact on who ultimately benefits.
Another term that I find can be a little confusing sometimes is anti-dilution provisions.
Anti-dilution provisions.
Yeah, what are those?
So anti-dilution provisions are designed to protect investors from having their ownership stake diluted. If the company raises capital at a lower valuation in the future, it's a safeguard against
down rounds.
Those scenarios where a company's value decreases instead of increases.
So if a company raises money at a $10 million valuation and then later raises money at a $5 million valuation, the investors who invested
at the higher valuation
are protected from having their ownership
diluted. Anti-dilution provisions come in various forms, but a common one is a weighted average provision, which adjusts the conversion price of the preferred shares to reflect
the lower valuation.
The lower valuation.
So it's a mechanism to ensure that early investors, those who took on greater risk by investing at a higher valuation, aren't penalized if the company faces challenges down the road. These provisions can be
they can be complex and
nuanced, but they play a crucial role.
In
protecting investors
and maintaining fairness, even if the company's fortunes change over time.
Now what about pro rata rights? I often hear that term thrown around, but I'm not.
So pro rata rights give investors the option to participate in future funding rounds to maintain
their ownership
percentage. So if an investor owns 10%.
10%
of a company.
A company.
And the company issues new shares.
Right.
In a future funding round.
In a future round.
That investor has the right to buy
enough of those new
enough to maintain their 10%.
To maintain their 10%
ownership. Right. Yeah.
Pro rata rights are valuable for investors, allowing them to stay involved as the company grows.
Right.
And potentially
benefit from future success.
But they can create challenges for entrepreneurs, especially when a company is performing well. And the funding round is
oversubscribed. Meaning there's more investors eager to invest than the company's willing to accommodate.
It sounds like a delicate balancing act, right? I mean, entrepreneurs want to
attract new investors
and capital.
Right, but they also need to
protect the interests of
their existing
investors.
Yeah. Skillful negotiation and open communication are essential.
They are.
In these situations, both sides need to understand each other's motivations and work towards a mutually beneficial.
Right. It's about fostering that win-win scenario.
Win-win.
Right. Where the company
secures the funding it needs to grow.
While both new and existing investors feel confident that their interests are protected.
Yeah.
It's a collaborative effort, I think.
Yeah.
That requires trust and a shared vision for success.
Now let's shift gears.
Yeah, let's shift gears.
And talk about another critical component of any venture capital deal.
Yeah.
The board of directors.
The board plays a crucial role, right?
Right.
Overseeing the company's, strategy.
Yeah.
Making key decisions.
Yeah.
Providing guidance to the management team. Exactly. And in venture-backed companies, the board composition
often reflects the power dynamics between founders and investors. You might have a board with equal representation from both sides.
Yeah.
Or you might have a board that's controlled by, one side or the other. And this balance of power can significantly impact the company's, direction and decision making.
So it's not just about the individuals on the board, but also about
the dynamics
and potential for disagreements or conflicting viewpoints.
Yeah.
And Kupor
highlights
this potential
for conflict.
Especially
during
acquisitions or when a company needs
a rescue.
Through
a down round or
a down round
recapitalization.
Yeah. And he stresses the importance of
the
board that can work constructively. Even when there are differing opinions.
Absolutely. It's like any successful
relationship, right?
Yeah.
You need to be able to
communicate
effectively.
Yeah. Compromise
when necessary. And ultimately make decisions that benefit
the partnership.
Yeah. Right.
Even if it means
Yeah.
putting aside personal
preferences. Yeah. It highlights the human element, I think, of venture capital.
And it's crucial, I think, for both entrepreneurs and investors to understand
the dynamics
of board governance. And choose board members.
Who are
not only qualified and experienced, but also aligned with the company's vision and values.
We talked about down rounds from the perspective of valuations and term sheets, but I'm curious to hear more about how Kupor views them.
Yeah. We touched upon
down rounds earlier,
but I think Kupor's perspective is worth exploring further.
Okay.
Remember, A down round.
Yeah.
Happens when a company
raises money at a
lower valuation.
Lower valuation than its previous funding round.
Right. It can be a tough
it can be
pill to swallow, both financially and emotionally.
Yeah, I imagine it can feel like a
setback,
a blow to the
company's progress.
Yeah. Right.
But Kupor, he encourages us to kind of reframe down rounds as potential opportunities.
Okay.
He argues that they can serve as a reset, a chance to recalibrate the company.
Okay. Address any underlying issues.
Yeah. And ultimately emerge stronger and more resilient. He shares insights from the Bloodhound case, which highlights the legal intricacies and potential conflicts that can arise during a
down round.
But also emphasizes the importance of clear communication, strategic
decision making,
and a willingness to adapt to changing circumstances.
So it's not necessarily a sign of
it's not a sign of failure, but rather a potential turning point.
Yeah. Now let's talk about the ultimate goal.
The ultimate goal
for many in the venture capital world,
exits.
Yeah. Whether it's a dream fulfilled for entrepreneurs, or a financial win for investors. Exits are often seen as
a culmination.
The culmination of the
It's a startup journey.
Right?
Yeah. For venture capitalists.
Yeah.
The goal is to generate those outsized returns by investing in companies that eventually go public or
are acquired. And for entrepreneurs.
Yeah, for entrepreneurs, and exit can represent the culmination.
Of years.
Of years of hard work.
A
chance to reap the rewards of their efforts and perhaps create a legacy. That extends beyond, the company itself.
It's the dream, isn't it?
It is the dream.
To build something
from nothing.